Hello and welcome. Thank you for being part of Equivault Company. Today we are starting our journey together with session number 5. Welcome back. Today, we're going to explore 3 powerful tools that every trader needs to understand. First, we'll look at the 3 pillars of market analysis: fundamental, technical, and sentiment. These are the foundations of how traders read the market. Second, we will review an introduction to technical analysis to better understand market behavior. Let's talk about the 3 big pillars of market analysis. Think of them like the 3 superpowers you need to understand how the market really works. We have fundamental analysis, technical analysis, and sentimental analysis. First, fundamental analysis. This is about the why. Why does a currency go up or down? It's all about news like interest rates, gross domestic product, inflation, jobs, or decisions from central banks. Simple rule: stronger data makes a currency stronger. Weaker data can make it weaker. Imagine a healthy economy. It pushes the currency higher. A weak economy, the currency drops. Next, technical analysis. Think of it as the map of the market. It shows you where price has been and where it might go next. We follow 3 simple steps. First, direction. Is the market moving up or down? Second, zone. Look for important areas like support and resistance. And third, trigger. Wait for a clear signal, like a breakout or a bounce, before you act. Charts are like a map. They don't lie about where price has traveled and where it might react again. And finally, sentimental analysis. This is about how traders feel right now. When traders are confident, risk-on, they put money into stocks or currencies like AUD and NZD. But if fear takes over, risk-off, they run to safe havens like the US dollar, the Japanese yen, or even gold. So sentiment is like the mood of the market: happy or scared, optimistic or cautious. Now we will see an introduction to the technical analysis. We will start with candlesticks in trading. A candlestick shows how price moved in a certain period of time, like 1 hour or 1 day. Each candlestick has 4 parts: open, close, high, and low. Now, the colors are important. A green candle means bullish. The price closed higher than it opened. A red candle means bearish. The price closed lower than it opened. There are also patterns. For example, a hammer. It has a small body and a long lower shadow. It can mean the price may go up. A shooting star. It has a small body and a long upper shadow. It can mean the price may go down. And a doji. Here, the open and close are almost the same. This shows indecision in the market. So, candlesticks are like stories. They tell us how buyers and sellers are fighting. If you learn to read these stories, you will understand the market better. Great! Now that we understand candlesticks, let's step back for a moment. The market is always moving up and down, represented in a quadrant where it shows us the price on the right and the date below. This movement is what we call price action. Candlesticks are just one way to show that movement. But there are other ways too. For example, we can use line charts. They connect the closing prices with a simple line. It's very clear and easy to read. We can also use bar charts. They look a little like candlesticks, but with simple lines for open, close, high, and low. So remember, candlesticks are popular because they give us more details. But they are not the only way to see the market. Let's talk about trends and support and resistance. First, trends. A bullish trend means the market is moving up. A bearish trend means the market is moving down. And a sideways trend means the market is moving flat, without direction. To see trends, we often use trend lines. We draw a line connecting the lows in an uptrend or the highs in a downtrend. These lines help us see the direction more clearly. Now let's talk about support and resistance. Support is like a floor. It's a price level where the market often stops falling and goes back up. Resistance is like a ceiling. It's a price level where the market often stops rising and goes back down. There is also something called change of polarity. This means if support is broken, it can turn into resistance. And if resistance is broken, it can turn into support. So trends, support, and resistance are like the basic map of the market. They show us where price is moving and where it might react. Now, let's talk about some technical indicators. Indicators are tools that help us read the market. They do not predict the future, but they give us extra information. First, trend indicators. The most common are moving averages. SMA, simple moving average, shows the average price over a period. EMA, exponential moving average, gives more weight to recent prices. They help us see if the market is going up, down, or sideways. Next, strength indicators. For example, RSI, the relative strength index, tells us if the market is overbought or oversold. MACD shows us the momentum, if the trend is strong or weak. And the stochastic indicator also helps find possible reversals. Finally, volatility indicators. Bollinger Bands show when price is moving strongly or staying quiet. A TR, the average true range, measures how much price moves on average. So remember, trend indicators show direction. Strength indicators show momentum. Volatility indicators show movement size. Thank you for your attention. Keep learning, keep practicing, and we will meet again in our next session.